the things that can push yields higher or lower are inflation expectations. But even when inflation is flat, yields can still be pushed higher because of term premium. The market doesn't believe the Treasury. Japan and US dollar is causing stress. The MOVE index is rising. Japan selling equals a feedback loop. The Bank of England is doing a silent intervention. All the central banks are injecting liquidity into their bond markets at the moment to ensure that we don't have... All right, welcome back. It's another episode of Money, Markets and Mayhem, and the mayhem has definitely kicked up a gear in the last week or so with Bitcoin flying through all-time highs. At last check, I think it's back down to 117 after hitting 122. So we're getting a little bit of digestion here, which is normal. Please don't be scared and sell your coins. Hold on to those Bitcoins. The whales want them. So first things first, I'm going to give a little bit of a trade update or a 10K challenge update for those that are following along at home. I'm also going to drop the link for any new viewers who want to join that 10K challenge and follow along and see how I'm trading options to basically try and take a portfolio of mine from $10,000 AUD all the way up to $100,000 AUD. So far, we started the challenge on the 9th of July, so it hasn't even been a full week, and we are up 48%. So the account total is sitting at about $14,823. That, and we are also sitting in about, let me have a look. We're sitting in $6,500 AUD cash. So we've got two positions open at the moment. We've got a Rocket Lab call and we've got a Tesla call. I won't go into details with them now. You can check my trade wrap update to see where we're currently positioned, or you can sign up to the 10K challenge below. Here is the sign up page, and you will get trade updates when I make a sale or when I make a buy. But yeah, we started with 10K. We're sitting with 6,500 in cash. So even if we lost all the money on our current positions, we'd still have our 6,500, and our account is, account total is around about that 14,800. So that's up 48% since July 9th. I'm not sure that there's too many other places out there that can show you those kind of returns, but hey, that's the experiment that we're going on here. So I hope you guys are enjoying it. As always, make sure that you ask your questions in the comments, and I hope that you guys are playing along at home. I posted a scene from Top Gun the other day where Maverick is in the firefight in the last scene, and he flies through the enemy's jet wash, and because that reminds him of when his Rio Goose died in training, he's like, it's not good, and he disengages, and his Rio is like, come on, engage, goddammit, engage, and the generals back in the ship are saying, engage, and bull markets are like that, right? Like, bull markets are difficult because things are just skyrocketing up, and it's like, you sometimes find it difficult to get in there and engage, but you just got to get in there and you got to have a crack. Bear markets, for most people, are even harder because they can't handle seeing their hard-earned go down. I actually love bear markets. I must be some sort of masochist, and I'm pretty good at buying and riding things down. But I get a little bit more anxious in these bull markets, right? It's like you've got to make sure the setup's good, and so here is where having trading rules is really starting to help me to become a better trader in the bull markets as well. Also, you'll notice that I'm using these headphones this week. It seems like I've got a problem with my mic, so I'm going to try these this week, and I want you guys to give me feedback on what you thought had better sound, these or the mic that I've been using in previous weeks. All right, now given that we're going to be doing a trade update every Saturday and releasing that Sunday, Monday, I'm going to zoom out today. I'm not going to be looking at charts. I'm not going to be going through trades. I'm going to look at some macro things that are on my mind, and I'm going to show you how I use ChatGPT to go deeper on the macro. But first things first, I wanted to point to this article that I found when scrolling online. So it was done by MIT, so the University MIT. And the article basically says ChatGPT may be eroding critical thinking skills according to a new MIT study. Okay, so I'm going to go through a bunch of reasons why this study should be disregarded and is pretty much a load of shit. The first one is the study basically only had 54 subjects, 18 to 39-year-olds. So yeah, really big sample size. They put them into 3 groups and asked them to write several SAT essays using OpenAI's ChatGPT, Google's search engine, and nothing at all. Researchers used an EEG to record the writer's brain activity across 32 regions and found that of the 3 groups, ChatGPT users had the lowest brain engagement and consistently underperformed at neural, linguistic, and behavioral levels. Okay, first of all, other than at school or university, where are we writing SAT essays, right? Like in the real world, we are not writing SAT essays. Now, I think that there's a case to be made that I could become a better podcaster and a better presenter if I learned how to write better essays, right? If I learned how to frame an argument, if I learned how to create the structure, if I learned how to create the intro, the conclusion, the supporting evidence, if I learned the essay structure, there's an argument to be made that I could become a much better podcaster. But when we're talking in terms of getting like real world results and using ChatGPT as a tool in order to augment, things like trading and research, like it's like hands. It says here, right? It says here, over the course of several months, ChatGPT users got lazier with each subsequent essay, often resorting to copy and paste by the end of the study. Okay, sure. If you are going to use ChatGPT and simply copy and paste what ChatGPT says and put it into an essay and hope that that's going to deliver you the results that you need, you're probably going to have a hard time. And think about it. If you were doing this survey that had no real world consequences, you would probably just copy and paste too, rather than going to the hard work of changing that around. So I just think, honestly, I think studies like this are going to come out. And I don't know what the intention of these studies are, but I think they're ridiculous, right? Like I've been reading a lot about AI and man, the amount of disruption that is going to occur in white collar jobs over the next 3 to 5 years is going to be ridiculous. One of the biggest companies in the world, Meta, formerly Facebook, had some of their best profitability results in history. And at the start of the year, they've laid off 5% of their workforce. Why are they doing that? They're doing that because they fear becoming obsolete. It's never in history has it happened that you would have record profits and results and you would then go and decrease your workforce by 5%, right? This is the nature of the profound impact that AI is about to have. It's going to create zombie companies so quick. It's going to obsolete companies and processes and jobs so quick. And what we need to be doing is we need to be using the number one skill that we have as humans, probably the thing that most differentiates us from all other animals, is our creativity, is our consciousness and our creativity, our ability to use ChatGPT in ways that people wouldn't typically use it, right? We need to consider ChatGPT a tool, and we know we need to go use it as a tool that augments our ability to be creative. So, I'm hopefully going to illustrate some of that in the next little piece that I show. It's a little segment where I'm going to explain bond yields and some of the things that are going on at the moment that I'm watching that worry me a little bit from a macro point of view and makes me think that, short term we might be right for a bit of a correction. But yeah, guys, like even some of the spiritual gurus out there are quoting this article and saying that, we got to be careful that ChatGPT doesn't make us dumber. And we do, right? Like if we are just teaching kids to go and copy and paste in order to get A's in their reports, then yeah, they're going to be dumber. But if we can use it as a tool to go deeper on our research, to basically expand our thinking on various topics, it's going to be powerful, right? And I've used it for finance. I've used it for macro. I've used it for macro research. I've used it for chart analysis. I've used it as my own personal psychologist. And it's taking me to places that I've never been able to go previously, right? So yes, having the mix and the balance of ChatGPT and your own work is going to be important. Like if I just went out every week and just ChatGPT'd what should I speak about today, and then verbatim copied those things probably wouldn't be relevant. But it's about trying to expand on the topics, even making the topics a little bit more clearer so that I can more articulately understand what's going on. Let's look at a topic now. But just before I do, this is interesting. So I put this article into ChatGPT and I said, did they used to say that the internet and email would also make us dumb? And ChatGPT comes back and says, yes, they did, and often still do. When the internet and email started gaining widespread adoption in the 1990s and early 2000s, there were plenty of critics who warned that they could make us dumber. Here's how the arguments typically went. The internet will make us dumb. Too much information, shallow learning, loss of memory. We'd rely too much on search engine and external memory, a concept now called digital amnesia, reduced attention span. Early studies and media blame the internet for a decline in attention and patience. That's probably a good point, right? Like I definitely feel like the internet and social media is contributing to people's ADHD. Email will make us dumb. Constant distraction. Emails accused of fragmenting our time and making deep work impossible. Over communication. Well, look, just in relation to that, I don't even check my emails anymore. Sometimes my team gets so frustrated at me. They're like, oh, have you checked your email? I sent you this. And I'm like, no, I don't check my email, guys. And that's because I want to focus on deep work. Over communication, that's another one that's actually true. Instead of making us more productive, some said email cluttered our thinking and made us reactive rather than proactive. So some of these things are actually true. Like I'm reading this now and I'm thinking, you know what? This is correct. Email and internet and social media has made some people dumber. Because if we just use these tools and are constantly just checking our email and then responding based on what we're reading in our emails, it is going to make us much dumber. But what intelligent people do is try and eliminate those distractions and try and use things to their benefit. So, I don't even check my emails anymore. If someone needs to reach me, they know that they can reach me in WhatsApp, and I have my notifications turned off in important times, and they can reach me in WhatsApp, and it's more efficient and it's more effective. But let me also ask you this question. If we have humanoid robots, if we have AIs that basically start doing all the running around, all the administrative tasks that we currently do, how much time do you think you're going to get back? Now, if you get all that time back and then you waste it by doing things that aren't creative and aren't very stimulative or aren't augmenting your ability to think and solve bigger problems and learn more, you are going to get dumber, right? Like the warning is you will get dumber, you will get lazy, you will get complacent. But what I think everybody needs to be focused on is using that time, right? Using that time more effectively to excel in certain areas, to really skill up in certain areas. And I hopefully that's what I'm trying to show you with this journey of how I use ChatGPT, even the trading challenge. I'm trying to give you in real time the moves that I'm making so you can kind of track those look at those and analyze those and work out what they mean, right? Like you guys should be really putting everything that you're seeing on my podcasts into an AI like ChatGPT or Perplexity and ask it to analyze my patterns. Ask it to work out whether you would be able to implement those things at home, right? You really need to be thinking of it as your ability to become superhuman. So as many of you know, I follow the macro researcher and commentator Luke Groman, and every Friday he releases his tree rings report, which is basically the 10 most important things that he thinks occurred during the week, or the 10 most important signposts that he saw that happened during the week. So he basically takes tweets, articles, comments from political leaders, and he puts that into a 10 things that, basically 10 things that made us go, And what I basically did is there was these first 4 things on his last Friday's report, and I'll quickly go through what they are because I think that helps to create context. So the 10 most interesting things we've read recently. Bessent, number 1, Scott Bessent, the US Treasury Secretary, says he wouldn't lift long-term US Treasury sales at today's rates. Number 2, Bank of England short-term open market operations balance now up to nearly £80 billion. Number 3, Trump threatens higher tariffs on Japan and South Korea. And number 4, Trump BRICS are trying to destroy the dollar. Number 5 was also under Genius Act. Banks can use reserve balances at the Fed as collateral to back stablecoins. So Luke then puts a bunch of news reports, articles, and charts that support the links that he finds between those 4 things. And I threw that into ChatGPT today, and I said, okay, give me a summary of what's going on here. So I said, what are your thoughts on all of this and what happens next, right? And you can see that I've pasted the first 3 or 4 points with the charts that went with it. And this was incredible. It says, okay, too long didn't read. We're on the edge of a global bond volatility spike that could either trigger a liquidity event or force coordinated global easing. The fuse, the breakout in the US 30-year, driven not by excess supply, but by lack of demand, foreign selling pressure, and policy jawboning that markets no longer respect. So number 1, the cup and handle on the US 30-year, a warning shot. I can show you that image as well. And, ironically, the great Martis, this guy is one of my favorite contra stream people on Twitter or X. I'm always following him to basically, sometimes do the opposite. He's always very bearish on Bitcoin. You do have to take some of what he says with a grain of salt, but this chart pattern that he is referring to, it's called a cup and handle. And this is a very high probability chart pattern of playing out. And if this cup and handle does play out, it screams that the US 30-year is going to break much higher, right? And that's going to have some consequences for macro, which is the warning shot. This breakout matters more than normal. So unlike Japan, anyway, what I'm going to do, global feedback loops are cracking, foreign holders under pressure, the bond market is calling everyone's bluff. What I'm going to do is first I'm going to go through some of the basic things that you need to understand to get an understanding of what's happening with relation to global bond yields. And so, guys, you'll notice as well, I don't know how to write essays. I'm not college educated, and I'm not naturally a presenter. And so explaining these complex topics in simple terms is not something that comes easy to me. So I'm actually using ChatGPT to try and help me to explain these concepts to you guys in real time, even though I have a weakness in this area. And the reason I'm doing this is because I think my understanding of these topics and my ability to explain them more is only going to strengthen my ability to trade around these topics, right? It's only going to strengthen my ability to understand. So What I've asked ChatGPT to do is basically give us a basic intro into all these wonky concepts. Think beginner's guide to ensuring they understand what happens next. And it gives me the beginner's guide, understanding about what's about to potentially break, right? Now, keep in mind that this has the potential to break unless governments and central banks inject more liquidity. And what I'm basically betting on, my base case, is that the governments and the central banks are about to inject liquidity. And later I'm going to show you what ChatGPT suggested would be the best assets to own in this environment. And this is also the reason why I'm so bullish on crypto, Bitcoin, and Bitcoin treasury companies, and even gold, and even some stocks, right? But here's the beginner's guide. What is the 30-year yield? That was something that we discussed at the start of this segment, right? The 30-year yield is the interest rate the government pays to borrowers to borrow money for 30 years. When the 30-year yield goes up, it's getting more expensive for the US to borrow. Investors demand higher returns because they don't trust long-term stability. It's like someone asking for a higher rate to lend you money if they think you might lose your job. What is term premium? Term premium is the extra yield investors demand to hold long-term bonds instead of short-term ones. Why? More time equals more risk. If inflation, debt, or political dysfunction rise, term premium rises too. Think of it as the uncertainty tax baked into long-term debt. Why does Japan matter at the moment? Japan is one of the biggest buyers of US bonds, aka treasuries. But lately, Japan's own interest rates are rising. That means Japanese investors are selling US bonds to protect themselves. Imagine your best customer is suddenly in trouble and starts dumping your product. That's Japan, which causes pressure on US bonds. What is the bond volatility move index? Just like the VIX tracks fear in stocks, the bond index tracks fear in bonds. When it spikes, bond traders are freaking out. This shakes up everything. Interest rates, stock prices, risk models. Think of it like a storm gauge for the entire financial system. So I think that the move index at the moment is actually more important than the stock VIX volatility index. Because bonds are the underlying collateral for the whole system, any moves in the move index are really, really important because they force funds that control the majority of the capital that's flowing around to take down risk, right? So, and with the environment that we're in, we're very sensitive to move index. Move index usually goes first, and then stocks can have some difficulties. So we need to watch that because the move index has started to tick up. What is a breakout? So we mentioned the term breakout with the 30-year. A breakout happens when a chart explodes past a key level after building pressure. In this case, the 30-year yield is breaking a 10-year ceiling. That signals a major regime shift, not a short-term blip, like water bursting through a dam. Once it breaks, it floods fast. What is a fiscal credibility crisis? It means the market is starting to doubt the government's ability to manage its finances responsibly. Too much debt, too little discipline. The market starts saying, if you don't raise taxes or cut spending, we want higher rates to compensate. It's like a credit card company jacking up your interest rate because it sees you're overspending and not paying it down. Let's go back to our first summation of Luke Groman's report. The cup and handle on the 30-year, a warning shot. The breakout in the 30-year yield, which we showed here, is technical confirmation of a deeper structural problem. Markets aren't buying the idea that long-end issuance will shrink or that demand will suffice even if it does. Besant saying, why would we issue long-term debt now, might have meant to calm things, but it has had the opposite effect. Traders heard we're not locking in today's yields, which means more short-term issuance risk and less liquidity at the long end. Translation, no bid, yield up. So what they're basically saying is Besant is saying we can't afford to refinance our government debt at the long rates because the yields are too high and we don't want to have to pay that yield. So we're going to have to finance more at the short end, the 3-month, the 2-year bond. And that allows them to roll over more frequently, but that is also more inflationary, more stimulative, right? Because there is more people out there that are willing to buy those short-term treasury and short-term paper. And that basically means debt monetization, and it's way more inflationary, right? Especially for asset prices. So why this breakout matters more than normal. Unlike Japan, where reducing supply drove JGBs up, yields down, the US bond market isn't responding that way. Why? Because foreign buyers, UK, Japan, are all under stress. FX hedging costs are still prohibitive. Bank of England is running STOMO at UK rate stability, like its life depends on it. So the Bank of England, all the Japan, all the central banks are injecting liquidity into their bond markets at the moment to ensure that we don't have a global sovereign bond crisis, right? And they are teetering on that edge of doing enough so that the market doesn't get spooked, right? And so this is something that's massive, that is basically one of the most important things. The currency cross rates, the US, the Japanese, the Chinese currency cross rates, and these bond rates are the most important thing in global macro, and it drives everything, right? Including Bitcoin. ChatGPT, and this is where the real power of ChatGPT comes in, and I want you guys to watch this carefully. I asked ChatGPT to take all this information, so I put the live charts of US bond yields, Japanese bond yields, the currency cross rates. I put Luke Groman's first 4 points from his Tree Rings report. I put all the explanations, like all the explanations that we've gone through in the thread have been there. And it came up with a playbook. And the first section of the playbook were the 10 concepts you must understand first. And guys, if you are interested in this playbook, sign up. What I'll get you to do is comment in the comments that you're interested in the playbook and sign up to the 10K challenge. And during the week, I will send this playbook to the entire database so that you guys can deep dive into this a little bit further. So please comment playbook in the comments if you're interested in a PDF version of this playbook. So section 1, the 10 concepts you must understand at first. So bonds, government IOUs. I won't go through all of these, but if you subscribe to my newsletter, I will send this out. Yields is the truth serum for risk. Term premium, the uncertainty tax, we spoke about that. Currencies reflect confidence. Japan is the stealth catalyst. Move index, the bond market's VIX. Chart patterns like cup and handle are triggers. Cash is optionality, not safety. So you often hear cash is trash, but sometimes cash is the most valuable thing you can have because it's optionality, okay, in the short term. Central banks are now reacting, they're not leading. And financial repression is the inevitable long game, right? Section 2, what's happening right now? You've got the 30-year yields breaking out. The market doesn't believe the treasury. Japan and US dollar is causing stress. The move index is rising. Japan selling equals a feedback loop. The Bank of England is doing a silent intervention. Short-term outlook, next 30 to 90 days. What could happen? 30-year yields could spike to 5.1 to 5.3, breaks global risk parity, forces a value at risk shock, reductions in big portfolios, margin calls next, SPX and NDX can get hit. Now, this is all possible, and the question, like this, none of this might play out because the governments and central banks might give all the stimulus and all the liquidity that we need to keep the party going. But this is outlining that there could be a short-term shock in the next 30 to 90 days. So to take this into consideration, and potentially it's time not to get too ahead of your skis here. Like if you're just putting money to work now at the market tops and you're going all in now and we get a correction, it's going to be difficult to stomach, right? This is not a warning to get out of all your positions, but this is potentially a warning for us to be a little bit more cautious at the moment, given the macro backdrop. Move surges, BTC could pull back and then rip, right? So this is important. Weak hands could get shaken with this, and then strong hands will reaccumulate because they know that the policy response is coming, right? Policy jawboning begins, etc. Long-term outlook. What is inevitable? So I asked that specific question in my prompt. What is the long-term outcome and what is inevitable? What is inevitable? Debt will keep growing. Rates will be managed, not market driven. So that's going to be like yield curve control. Inflation will be understated but persistent. USD will be weaponized and then debased, and only real assets will survive. Bitcoin, gold, land, commodities. Even stocks will bifurcate. Cash flowing monopolies win. Zombie companies will die, like we mentioned before. Now, this is the bit I love most. Section 5, ranked, and this is ChatGPT ranking them, right? Best assets to own long term. And it ranks Bitcoin as the best, gold as second best. That's something that I've spoken about on many podcasts. Then it says prime real estate. So not all real estate, prime real estate, inflation hedge, utility, and scarce location. Then it says energy and commodities. We've spoken about my energy position, and you can see that commodities are starting to rise, which is often what happens late cycle. Selective equities. So cash rich, anti-fragile, moats, price for survival, not fantasy. Maybe you'll see some Bitcoin treasury companies there in 5 to 10 years. Maybe some Bitcoin treasury companies will replace some of the S&P 500 zombies. Private credit, cash, and then bonds last of all, right? So the message is pretty clear. Get out of paper, right? Get out of debt. And you can take out debt, but don't want to own bonds, and get into hard assets and selective real estate, commodities, and equities. How to play it, tactical playbook. Look, I haven't read through this, but this is interesting, right? BTC. Let's go through this tactical playbook and let's see the ones that I'm actually doing, what aligns with what I'm actually doing. So barbell portfolio, real assets on one end, dry powder on the other. That's at the moment, in one of my portfolios, I've raised 15% cash, so I'm ready to go. I'm out of all my short-term positions. Buy stress. When the move or VIX spikes, look to add real assets. Yes, don't buy when everything's going up and the volatility is low. Buy when the volatility is high and everything is going down. Cut narratives, follow flows, positioning over opinions, 100%, always. I mean, there's so many people selling the sizzle online at the moment, and I'm doing my best to try and cut through that noise and give you the math that I'm trying to follow. Volatility is opportunity. The system will swing wildly. Your edge is preparedness. Now, tactical playbook. What am I doing here from this? BTC, DC during liquidity panics, go heavy if Fed panics, 100%. DCAing once a month for my business. And if we get a big sell-off back down to about 90K, I'll definitely go in a little bit heavier. Gold, add on USD strength, reduce when liquidity returns. I'm not really playing gold at the moment because I just think that there's more alpha and upside to be gained from crypto and trading around those positions. Real estate, refi smart, buy with yield, focus on control. So I have 2 properties at the moment that I'm between. One of them is rented when I'm not there. The other one isn't. I am actually looking to refinance both of these properties. I want to pull between $500 and $1 million equity out. I'm going to spend some of that money renovating the current property I'm in so that I can rent part of it out when I'm not here. So create a little standalone studio. And so the first thing I'm doing is trying to refinance these properties, pull the equity out. I don't want to lend money right now. I want to be borrowing money in a debasing currency. So I'm borrowing as much as the bank will give me at 5-6% because I think I can compound that much quicker. So I've rented out and renovated my property in Melbourne. It's giving me a yield. It's in a prime location that over time will do well. My property here in far north New South Wales, South Queensland is something that I can improve the value of and rent out to get some cash flow and improve its value if I ever go to sell it. And then I'm going to take the other half of that money and I'm going to invest it in things that I think can give me a better return than what the bank is charging me interest. And that'll be, things that we've discussed in this playbook. Stocks only own monopolies, cash generators, or hard asset plays. Well, I'm very light on stocks at the moment, but yes, I'm willing to own individual stocks over indexes, that's for sure. Puts, hedge near-term yield zones. So I am looking, and in the 10K challenge, you might see me put some downside protection on. You might see me put some puts on instead of calls. At the moment, we're being all one direction, but if things get crazy enough in certain things, I might put some puts on and cash ready to deploy, not to hoard, 100%. The cash ready to deploy is, in fact, your kingmaker. Kingmaker. Not king, but it's a kingmaker. Yeah, guys, look, I really would love and appreciate your feedback. What do I need to do better in these explanations? Has this macro explanation been helpful? Yeah, I know I'm not the best presenter out there. I'm not the fanciest presenter. There's some really good guys on YouTube right now, but I do hope that the one thing that I am doing strongly and to the best of my ability is trying to cut out all the hyperbole, all the bias and all the noise, and just try and give you the cold, raw, hard facts. So anyway, that's it. I hope you enjoyed. Nothing in this should be constituted as financial advice. Do your own research. I'm just trying to kind of give you tips on how I would go about becoming better and stronger in macro, if that's the reason that you're watching these pods. As always, if you enjoyed it, like and subscribe, and make sure you follow and sign up for the 10K challenge. We'll see you next time. Bye for now.